Hey guys, welcome back to Seller Sessions. Obviously, the regular of the show coming back is Brandon Young. Everyone who in the space will know who Brandon is. Check out previous shows, of course. Peter is new to the show. He's from Uncapped. Peter is a lending provider. We're going to get into this later. A few months ago, Brandon was talking about various different options for sellers as funding options. Today's show is about going through all of these options, and I wanted to bring on Peter because of discussions I've had. He feels that they can provide a really good service within the space, and we always discuss, Amazon sellers want to pay the lowest fees, etc., etc. Obviously, they want the safety net that work with reputable companies and stuff. So today's going to be a conversation going through all these different options. Brandon's going to talk through some of the calculations as well, and then we'll land on the show. We'll talk to Peter regarding Uncapped and how that will fit into the equation to give the various different options. So welcome to the show. Peter, do you want to give a little bit of background on yourself, and then we'll move to Brandon?
Sure. Very quickly, I'm founder and CEO of Uncapped. We are a 4-year-old company, and what we do is we specialize in providing working capital to e-commerce companies, specifically Shopify and Amazon sellers at large. We can do up to £5 million, and we start as little as 10,000. So we work with both the sellers who are just starting, maybe 2-3 months of a history, to those who are very established, doing our largest client has 100 million in revenue per year. We operate in Europe and the US, and super excited to be on the show.
You're welcome. Cool. Brandon, do you want to kick things off, and where do you want to start? What's the first funding source you want to talk about?
Yeah, I think that this all came about because of a post that I made that you hit me up about, and the number one lever for growth within our business is usually capital. Having more capital to find and launch more products and go faster. And so that's the bottleneck for most sellers, because we come into this business usually with a limited amount of capital to see if it even works. A lot of people are very skeptical about FBA, about private label. And then they say, okay, I'll throw 10,000, I'll throw 20,000, I'll throw 30,000 at it. And then they go through the process of finding and developing a product and then launching it, and they have some amount of success, or they see where success can be made. And then they decide to go from there. Now, once you get to 5 or 10 SKUs and your revenue is approaching $1 million, all of a sudden you're like, okay, instead of launching one product a quarter, I should be launching 2 products a month or 5 products a month. And that's very expensive, right? So where does that money come from? And then there's the other part of it where you have seasonality. So if you're selling toys like we do, going into Q4, I've got to spend $4 million on inventory this year. And so throughout the rest of the year, I've got sales that are flat or pretty good. Maybe there's a spike for summer toys or whatever. But when I have 5 months in the span of a month and a half of sales, then I've got to front load a lot of costs there. So I have to borrow money on a regular basis to grow my business. And it's been like that since I started. So like in 2016, we did $1 million when we first started. And then after that, it was 3 million, it was 7 million, it was 12 million, 22 million, and over 30 million this year. So that growth has always come from borrowing cash. And so, and then I see that journey, I understand that journey, and my students are going along that same path. And so I've always tried to work with lenders to offer capital to my members and my students. And so what I want them to be aware of is what the true cost of capital is. Because it doesn't do a lot of good just to grow the top line. If at the end of the year you break even or you lose money because you spent too much money to borrow money, that's a real threat. And I see that happen sometimes where people are so desperate to grow that they end up losing money in the year. They choose the wrong products. They go after faster markets, on the business side. But if it's something as simple as just choosing the wrong lender, that's an avoidable mistake.
Yeah. Cool.
I 100% agree.
Yeah. So where do you want to start first of the 4? What we kicking off as option 1?
Yeah. So I think that the besides debt, there's also the option of equity, right? So you can also sell a piece of your business to get some money, and that's money that doesn't need to be paid back usually until you have an event where you have another liquidation event. So another raise, an A round, B round, or like an exit. So whether you sell to someone, an aggregator, whether you go public, whatever you do as some kind of liquidation event. And that can be very expensive money if you're talking about having a big exit down the road. Right now, your company's worth $1 million and you sell 20% of it for a couple $100,000. And then, think about 5 years down the road, you sell it for $10 million. Now you're handing that someone $2 million. So you're paying back $2 million on $200,000 borrowed essentially 5 years later. So equity can be expensive, but it allows you to grow without the burden of having monthly payments or having to pay that back. So that's an option sometimes. Bank loans can be very good. So if you have long-term bank loans, 5 years or more, you can get those at usually very close to prime. And so 5%, 6%, 7% for 5 years can be a really good loan right now with how high interest rates are. And then the other part from a traditional bank would be a line of credit. That would be one where they say, okay, we see your revenue, we see the needs of your business, and we're willing to, with your current balance sheet and financial statements, we're willing to loan you $500,000 at any time. Every single time you take money out, it's at this interest rate that you're paying it back, and you can pull up to the limit of your line of credit at any time. You can pay it back as you want, and whenever any money is out, you're paying interest on it. And then that line of credit can typically be pretty cheap as well. Typically, slightly more than a long-term loan, but a little bit less. And oftentimes you can manage it better than a long-term loan because the long-term loan, you're taking all of it, right? So if you need to borrow, like in my case, I only need to borrow for a few months a year. I borrow in fall and then I pay it back by January. And I try to maintain zero balance on any lending for most of the year because it's very expensive once you're holding the money. As long as you're holding the money, you're paying interest on it. And so we try to borrow as little for as short a term as possible. So that long-term loan, even though it's a lower interest rate, you have the full amount for the full time. And generally what happens is they tell you take it all or nothing. You can't take half and then later go back and get the other half. But a line of credit allows you that flexibility. So the problem with bank loans, though, is that you need true financials. You need to usually have filed 2 years of tax returns. So for someone just starting out and starting to grow their business, that's typically not even an option. And that's one of the issues. And then there's international sellers that might have trouble getting lending because they're doing business offshore in the United States with Amazon.com. A lot of lenders, banks here in the United States won't lend to foreign entities. And the lending practices of each country are very different.
I think there's more problems, if I may, Brandon. I think, from our experience, and I can talk about equity later as well, I think, if your business can qualify for a bank loan, I think this is absolutely the best way to fund your business, fund for growth. The only problems we see is, first of all, usually the bank loans are fairly small versus the size of a business. And if you have a really profitable company growing and you know that you can make a good money on the new products, you actually will be running out of a capacity of a loans offered by the banks. And you will be leaving money on the table because you cannot buy the inventory to be making money. The bank will be telling you, okay, I can give you only that's maximum. And also they ask for a security, right? Like they want some very often personal guarantee, the assets. And as a founder, you know how stressful the life is. Do you really want to put the house you worked so hard on as a security for the bank loan? But the rate
that's a very good point, is the personal guarantee. And there are horror stories. So if you follow some big sellers on Twitter, you'll see that some of them have had personal guarantees, and sometimes it can take years for them to get out from underneath it if they've had a failed business. It can be something that haunts you for a long time. So oftentimes personal guarantees will be the deciding factor. Sometimes it's worth taking a slightly more expensive loan to not have to personally guarantee it, because anything can happen at any time in our businesses. We could get sued from, like in our case, we could get sued from Mattel, or we could have Amazon come in and shut down our entire account because they think that we're having safety issues, right? We could have a massive recall with our most popular toy and it costs us millions of dollars and puts us out of business. At any given time, like there's a number of things, I don't even want to put that stuff into the universe, but like at any given time, you have to be aware that shit happens, right?
So personal guarantee is tough, like I have in my background, I spent many years before starting a company as a VC, And my girlfriend has a bootstrapped company. So I have a very full picture of, bootstrapping versus VC funding. And I raised a lot of money personally as well. And my girlfriend has an amazing business, e-commerce business, e-commerce or wholesale. And she has a bank loans. And, in the last months, she had a bit of a overstocking issue, a typical problem in the current times, the boom, you buy too much stock, she's low on liquidity. And we were struggling to find the liquidity to service the loan. And she had a personal guarantee and the flat. And we were like, fuck, we really don't want to lose the flat. So like this is a real problem she was facing, and she was super stressed.
Yeah, no, I get it. And that's why that was a really good call out. I think that personal guarantees should be avoided if possible, right? So once you leave the banks, though, and there's been this ecosystem of lending companies that have popped up, including yours at Uncapped, which I want to learn more about today. I think Danny and I made the decision to actually talk about it on the call rather than me getting too much, so that I can probe and ask questions the way I've been anyone else.
That's what I wanted to do, because I think that's where the sincerity comes from. Because I said to Peter, and let's be straight, you're a straight shooter. I'm a straight shooter. I said, look, if you want to sit on a call, on a podcast with Brandon and confidently exchange ideas with each other to prove that you're a worthy service in terms of Amazon sellers' eyes, right? Because we know there are various great lenders in the space, but their fees are going to differentiate a lot. A lot of financial instruments, you need a medical degree to read through them and then compare them all, because there's always an upside and a downside somewhere. So I thought having this open conversation is going to gives a lot more clarity, because there's no one can go hiding here. Does that make sense?
Amazing.
Yeah, and I appreciate that, Danny. So we'll go through some of these options that I've seen throughout the years, and there's some creative ones out there, and there's become quite a big industry for lending because it's needed. And now, first, let me start off by saying I sympathize with the lenders in a lot of ways, because this business is really hard and a lot of people fail, right? So I would say that half the time we choose a product, we don't continue it. 70% of the time we make money on a product, but 30% of the time we lose money. So it's a numbers game for us, and we're taking probably one of the most calculated, approaches to choosing products, the way we choose products with data, the way we validate them, the way we do it. We feel our methodology is the top. Now, so if you go down that list, and then your default rate goes up significantly. So I know that 80% of people that enter, supplements will fail, right? Like maybe even 90%. It's an insanely expensive and very difficult niche to get into. Most of the products that those people launch will fail. A lot of the big spenders in the space, a lot of the big players in the space will launch 10 of the same exact product in 10 different brands, and one will succeed and they'll put their money behind it and they abandon the other 9. And the little things matter, like the way that the algorithm picks up the pay-per-click, the way that the people are attracted to the packaging. Like there's so many things that go into some of those more expensive categories, or more competitive categories. So I sympathize with the lenders in the fact that when they loan money, a lot of the times they don't get it back. So they have to offset their cost, right? Now, with that being said, I think that like a step up from banks would probably be Amazon lending, because Amazon lending has the full gamut of sellers, not just private label sellers. They have wholesalers, they have resellers that are generally more secure in being able to pay that back. So, and then they can spread out their risk across everything, so they can charge less. That doesn't mean it's less. I've seen Amazon loans as low as 9% for offered to us, but the typical is going to be 12.9%, 13%. And that's a very straightforward calculation, the way they do that. So the other thing we're going to talk about is some of the games that some of the lenders play with regards to hiding what the true cost of capital is. At least with Amazon lending, they tell you it's 12.9%, it's 12.9%, right? After Amazon lending, and the thing there is they only offer you what they offer you, and then they won't offer you a loan unless you've been in business doing business with them for at least a year. So in the first year, you're not going to get offered that loan. Now, what's interesting is they've started to take some partners on. I know that they deal with, it's not Morgan Stanley, but it's one of the other big
Goldman
trading
Sachs.
houses. What is it?
Goldman Sachs in the US.
Yeah, Goldman Sachs. That's right. So Goldman Sachs has come in. Now, Goldman Sachs is going to be more like a traditional bank loan. You need 2 years of financial reporting and tax returns. And so you don't qualify for that if you don't qualify for the other bank loan. And then their loan rate's going to be lower than Amazon's. But again, it's the same exact hiccup you have with the other loan, the other lender. So let's just ignore that for now and then just slate it in with the banks. So then after the Amazon lending, you've got these private companies. And there's 3 different approaches that I've seen on the lending side here. The first is going to be just a traditional loan where it's a fee. Usually it's a fee-based loan, which means it's not calculated by an interest rate. And the reason that they do that is because essentially it allows the lender to make more money on the loan. There are caps on how much interest you can be charged by lenders in many countries. And so that cap is often, less than what this fee-based lending system will provide. And I'll give you an example. If someone loans you $100,000 and then they tell you, no, all you have to do is pay me back $110,000. So that's 10%. You think you're paying 10% back. Now, the cost of capital would be just 10% if you paid it all back at the end of the year. If you didn't make any payments, and then at the end of the year, you paid back $110,000, then that true APR is 10%. But the problem is every single time you pay off a little bit, the payment doesn't go down too. So your interest rate is actually higher than the 10%. Your actual cost of capital is higher, your APR. So what ends up happening is if you're paying back weekly, it's compounded even more and it costs even more than paying back monthly. So a lot of times you'll see tricks where they'll say, okay, it's a fee-based thing and you're paying me back weekly. So if you borrow that same $100,000 and pay back $110,000 over 52 weeks with a payment of $21.15, which would be $21.15 times 52 is $110,000 roughly, you end up paying an APR of 19%. So you're in a position where your capital didn't cost you 10%, it cost you 19%. Now, when you start to take in that higher percentage of capital or cost of capital, there's 2 things you have to keep in mind. And this is where it gets a little complicated for people. If I only had one turnover of my inventory through the year, I bought one lot of inventory and I only sold through that one lot, my margin would have to be well more than 19% for me to make a profit. And a lot of times after all of my costs, my employees, my shipping, my storage, and everything else, my margin is not 19%. So I would lose money. The only way I can make money on that $110,000, the $100,000 that I borrowed at that 19% rate is if I turn over that same amount of money in inventory several times throughout the year. So you have to think about inventory turnover and how often you're compounding your capital and your business. And so sourcing from somewhere closer like Mexico can be massive because within 2 weeks you can get stuff trucked across the border instead of waiting 45 days for it to get over here on a boat from China, right? Things like that improve your inventory turnover rate are a massive advantage and can make borrowing less of a worry. But a lot of people don't realize that 19% oftentimes will end up, if you're making a net of 10% and you turn over your inventory twice, you made 1% on the year. You're making no money.
I think, Brandon, you're touching on something very, very important. Like for us as a lender, inventory turnover days and how fast you rotate through inventory is one of the key characteristics to identify good sellers, good merchants from poor merchants. Because not many people realize, like if you think about Walmart or like the big supermarkets, for them, turnover days, how often they cycle through inventory is the key thing to make the equity work, to make the capital work. And I meet so many founders, so many entrepreneurs who are only thinking, oh, I have an 80% margin. Sure, but like how long do you need to lock your money in for? This is something they really forget about. And this is something that we try to really educate the market about. It's not only about that. It's also about like how fast you can cycle through this money, as you said.
Yeah. And so our approach with our toys is it's a competitive market. We have to have an advantage on keywords, but we also have to have a price. It's a price sensitive market. So we have to have lower margins, but we turn it over faster. We're more efficient with inventory. We're more efficient with logistics, right? So we make it up on the number of turns per year. And so if you have to have full visibility on how finance works. And luckily, I have a degree in finance, right? So this is my background, so I understand cost of capital and finance and inventory and everything like that. And I had my Series 7 with Morgan Stanley, as a matter of fact. It feels like a different lifetime at this point. It was going on 20 years ago. Now, so besides that cost of capital, the fee-based cost of capital, there's several big players in the space there, right? So the one that I would say, and maybe you're in that boat, and I don't know much. I'm gonna ask Sean. I'm gonna get a chance to grill you in a second. Now the ones that I know of that are in the space are going to be Sellers Funding, which is now Sellers Fi, and I've always had a good relationship with them. They've very transparently, they're going to be in that 19% area. They say that they're in the 16 to 20% mark, which is pretty accurate when you calculate the fee and how often you're paying it back and whatnot. But once I actually started calculating the cost of capital, even with those things, it was well over 30%. And so I couldn't in good conscience recommend anything over 30% to any of my students, any of my members. So I gave them their money back on the sponsorship, and I haven't had them sponsor anything since. And this was a year and a half ago. Now, in all fairness, they've reached out. They said that they're willing to create a new product for qualified sellers that could be cheaper, and they want to do some things. And I don't blame them. I think that, if they know that someone qualifies, they should give a lower rate, right? Like, I think that that's the way it should work. So maybe we'll see where that goes. But in the meantime, like, for their standard product, it's 30% absurd, right? Like, I
agree. It's very expensive. It is, it's still not as expensive as MCA. The history of our companies, we started as an MCA lender, and this new generation, I don't know if you remember Clearco, etc. And revenue-based financing, this was such a huge trend. And we initially started the company doing that.
That was like 50%.
Exactly, right? It was bonanza. But, what's the biggest problem of MCA is it's unfair to the clients. And if something is unfair in the long term, it's not a good product. What it was making, because maybe for the listeners, quick reminder, basically the product worked like you agree on a fixed fee, let's say 9%, 6%, and you give me agreed percentage of revenues. So every day you're giving me 10, 15, 20% of your sales until you repay the loan plus the fee. Let's say you borrow 100,000, you'll pay me 106 back. In theory, it sounds great. Hey, I don't generate sales, I don't repay, it's super flexible. The problem is following. Good clients are penalized. Your revenues go up, you repay faster, the real APR on the loan is increasing. It's a terrible product, both for the lender and for the client. I want my good clients to be happy. I want my good clients to pay less, to have better rates. So we haven't done a single RBF loan in 2 years' time. If you go to our website, though, you can still see them. Why?
So I just want to recap that a little bit. I think that that's the other type of loan I was going to get into, which is you pay back as a percentage of your sales, right? And so a lot of people think, oh, it's good. If I'm making sales, I'm paying back. If I'm not, I'm not. What ends up happening is that you pay back so much faster, typically, that you borrowed the money, your payback period your cost of capital goes up significantly. So now you're in that 25 to 35% range typically.
Totally. And listen, it's not a good product. So we have it on the website just because people are searching for it. And we don't offer it when we explain to them, hey, this is not a good product for you. I know this is what you're looking for, but actually not. You want something different. You want to have a fixed repayment schedule. You want to know what are you repaying and when, and you have a very clear understanding how the payments will be looking. You don't want the RBF or MCA.
Exactly. Yeah. I think I agree with that. So you covered that one. The last type of loan is going to be not a loan. It's going to be a partnership, right? So Danny and I are friends with a few guys that bonded together to create a new company called SoCal. And I absolutely love what they're doing. So you're talking about the guys from Multiply Me and Ascala, and the former CFO. I think he was the CFO of SellersFi. They came together and they've put together the pieces to provide you with capital and with processes, so SOPs and mentorship. So what I love about this is that when we hit a barrier at 10, 12 million, we had to hire a CEO coach. To build a real company to go to 50 and 100 million, you have to really get good at business management practices. So having quarterly planning sessions, understanding how to work backwards from goals, what resources you need, how to decide what levers to pull, how to hire, how to train, how to give career progressions, all those things. You have to learn how to do them. Very different than just finding a good product and launching it on Amazon, right? It's just not, it's a world apart. So most people are bad at that. Most people don't want to do it. Most people don't want to be a manager. They just want to run their own business and stay small, and that's fine. So what happens is they'll come in and they'll say, okay, right now your business is worth $5 million. And you guys agree on that valuation. And they're usually pretty high on it. Like they're very generous. They'll say, let us come in. We'll provide you with financing. We'll provide you with partnerships and with processes and people, help you hire people to grow to a valuation of 20 million in 2 years, 24 months later. But the agreement is we're going to sell it in 2 years. Now, anything that we help you grow, we get a percentage of as a partner. You keep your first 5 million that you've built. You've done all of that. You get 100% of that. But with our help, let's accelerate that growth. Let's take it to new levels. Let's really go to the moon. And then 2 years later, let's say we sell it for 10 million. We only get paid on that $5 million difference. And as a partner with you. And I think that that's brilliant because I think a lot of people need that support. They need that help. They need those processes. They need that capital, and they're not paying the loan. So all the capital that they're getting is going straight into growth without those payments back. But it's proven, right? They've taken clients, and they've got clients that they've worked with that have grown. And I think that type of partnership, and that goes back to the equity discussion like that we had that you Peter said that he can contribute to with his VC background. And so it's that's the other type of lending that I think is potential or capital, like the bringing on resources. At the end of the day, it's resources, it's people, and it's capital. At the end of the day, when we do a quarterly planning session or an annual planning session, and we say we're going to pull these 2 levers this quarter, we have to work backwards from there and say, okay, what is the leading activity we need to do every day to pull that, to truly move that lever and move the metric that we're trying to measure? And it's like, what are the resources required? And it's usually capital and people, right? So it's number of workout man hours and costs. So if you can get those resources from someone all at once with a partnership and you qualify for that, then SoCal's great. But other than that, I mean, I'm interested to hear more about now Uncapped.
Yeah, let's get into it. I was going to say, we're coming up to the 30-minute mark. It'd be nice for Peter to chime in, and Brandon, I know what you're going to do. Let's break it down and go through it, because the goal of the end of this call is to get the best options out there for sellers. So let's the floor is yours, gentlemen.
Sure. Very quickly, Uncapped, I think we provide working capital, as I said, to e-commerce brands, Shopify merchants, Amazon merchants. Our product is very simple. I mentioned earlier, we are not fans of RBF. We offer a very simple amortizing loans with a fixed fee upfront. So let's say we're very upfront about it. We charge from about 0.7 to 1.2% fee per month. And the average loan duration is from 4 months to up to 2 years. So the APR at the end of the day, real APR as you like to call it, ranges from about 16 to 25%. It very much depends on the size of a merchant, the stage where they are at, because we can start the very, very, very early stages of development. Our smallest clients, they have a 20, 30,000 sales a month. These are frankly very risky customers, and no one wants to lend to them. You need to charge them more for 2 reasons. One is frankly operational. From a lender perspective, it still takes a bit of work to to do the work, do the analytical work, to do the KYC, KYB, do the analysis, support them, have a salesperson, have a calls with them. So
yeah, so this is a great point, Peter. I just want to say I sympathize with that side of it on the lending side too. Your overhead to issue a loan is the same, and to issue and service that loan is the same, whether it's a $10,000 loan or it's a $1 million loan. And so at the end of the day, if you're only making a couple $1,000s on that loan net, you might even be losing money based on the cost of your people and your time.
Cost of acquisition, right? Like if it costs a few thousand, up to 3,000 to even acquire a customer. On the higher end, we have a largest merchants. They do, as I said, up to 100 million a year in turnover. There, you can lower low pricing. Like I think we cannot get as low as Goldman Sachs because our cost of capital is too expensive. But we are in the high teens range, where I think we compete directly with Sellers Fi. I think it's our biggest competitor globally, and we are more or less at the same range as them. We have a product called Line of Credit for the largest merchants, where we allow merchants to they don't have to pick one loan. It's a fully committed line to them, where they can draw tranches as they need. So, for example, we give them 2.5 million line, 3 million line, and up to this quantum, you can do the draws as you please. So today I want to borrow, for example, 1 million for 4 months, and next month I can borrow additional 500,000 for 12 if I need. We allow you to plan, we allow you to choose. What's I think very special with us is we really put a lot of work into understanding the customers and working directly with them. We are still fairly, small business. We are less than 100 people, and we give customers a lot of personal touch. I personally speak with almost every borrower who gets a loan above 1 million from us. We understand them. We want to understand their cycle, their seasonality, what are their plans, and we want to make them succeed. My passion is in entrepreneurs. I've been a VC before. My partner is a founder as well. So I understand the space and I understand the entrepreneurs and the story we're going through.
That's awesome. Danny?
Well, I put the floor to you two guys, because obviously the outcome here, look, I'm not strong on financial instruments, and that's why I wanted to bring you in, Brandon. And going back to your point about sponsorships and stuff, I have to be very careful on who I select as sponsors as well. It's probably cost me close to $250,000 in the last 3 years in sponsorship, because there's deals I just won't do. I have rejected funding companies, factoring and stuff. And the thing is with factoring, it's not that it's a bad instrument. It's the person that takes it. If they haven't got financial literacy and are using it as a tool for the right meaning in that short-term period, it isn't necessarily going to be a fit for them. But you still get that blowback. So I have to be very careful about who I take on as sponsors, because the sponsors I take on reflect me. And so if I put them at Seller Sessions as sponsors, that's me co-signing them. And so I have to make important decisions. And I'll be the first to admit, I'm not strong in financial instruments. I thought, right, why don't we bring Brandon in? I've been speaking to Peter for a while. Let you two have a chat about it. We have an open call, and then everyone's got clarity. So, people that listen or watch the podcast can then make informed decisions, because they need to get funding based on their best application of what can be provided for them depending on their circumstance. And that's it for me,
Yeah, I think you hit the nail on the head there. And the biggest thing that you have to know, like, when you raise money, Peter will know this from a VC perspective, and I've done some angel stuff, and I love it. When you get a deck from someone, or you look at their deck, one of the most important things that you see is the use of capital, or the use of proceeds. What are they going to do with the money they raise? And so the same is true with a lender. The factoring, although it can be expensive, if you're able to take that money in a short period of time and turn it over and make 3 or 5 times the cost of that capital, it can often be worth it. And the reality is, it doesn't work that way in private label most of the time, because we have such long cycles, right? We have to get that money out to a factory and get it. All the inventory needs to get here and whatnot. And so Peter's saying that one of the number one things they look at is inventory turnover. It's because that's the health of the business. At the end of the day, if the margins are smaller, but they're turning it over 5 times a year versus 2 times a year, oftentimes that company can be more profitable. That 5 times a year company can be more profitable. Because one of the things we've always looked at in our calculator internally with seller systems, because we do it ourselves, and what we've taught our students to do is look at an annualized rate of return. So you look at an annualized ROI on the product. And what's funny is sometimes you'll pay for a more faster shipping that's more expensive because it gets here faster and you can turn over your inventory faster. So the hit on the cost of your capital or on the cost of your product from a whole will be more. But if you can turn over your inventory an extra 2 times in the year, at the end of the year, you make more money doing that. And a lot of people don't think in terms of long term. They just try to get everything as cheap as possible.
Another thing I'll tell you, what we are looking at, because I think this is where conversation is interesting, and I'm happy to share, how are we looking at the companies as a lender to give tips to the clients. For us, another big thing we're looking at is like how stale your inventory is. One of the things I'm most worried about is that the merchants don't realize that how much overstocked they are. And, they think they're profitable, because it's very funny how finance works. Cost of goods sold only include the costs of the inventory you sold, don't include the fact that you might have spent a lot of money on inventory, which is not moving. And the stale inventory, I see it as very often, especially nowadays when the e-commerce boom stopped, as the biggest risk to the liquidity and to the basically sustainability of a lot of e-commerce companies we see and we speak to.
Yeah, I think it's inevitable, that you're going to have dead inventory in this space, or you're going to have ups and downs. Our approach is a little different than a lot of the other sellers, because I noticed that a lot of sellers will really go all in on a couple SKUs, and then they really stop growing because they really just want to focus on those. And our approach is, we know it's a numbers game, and we've been burned enough where we have a bestseller that all of a sudden the next day is not a bestseller. And so we know that if we launch 100 products a year, a few will become top 1,000 BSRs, a few more will be top 5,000, a few more will be top 10,000, and a few more won't be good at all. And so we need to launch a lot of products, and 2-3 years down the road, those ones that were bestsellers 2 years ago are no longer bestsellers. The market evolves. And so we're trying to create internal processes. And if you look at the inventory, it's often stale for some of those faster moving products that all of a sudden aren't faster moving. It's like you got 6 months of inventory sitting there. What do you do? So where do you draw the limit? Or what is the number you're looking for that's ideal? Is it a certain number of days of inventory?
Yeah, I think for us, when the number gets above 180 days, this is when we are really, really worried. And I think, the healthiest companies you see, usually that it's maybe about 120 days. So, you have 4 months of inventory. This should be plenty to sell, to seasonality. Above 180 to get worrying. Above 270, this is a huge red flag to us.
Yeah, and we even try to stay way below 120. Like, we're trying to maintain maybe 2 months of inventory, 60 days max, right? Like, we want to be in that 45 to 60 day sweet spot and that's between all warehouses. At Amazon, we want to have 30 to 45 days, and then maybe another 15 to 30 days at another warehouse.
But this means you are a very efficient business. I think a lot of merchants we talk to are not as efficient. They don't have processes, because to have 60, 90 days of inventory means you really need to be good at reordering, and you need to have a scale, because maybe MOQs are actually you need to be hitting MOQs. So it's difficult. So I think 180 is reasonable for maybe companies that are growing and have to buy and try. Below 120, this is perfectly fine from what we see internally.
Yeah, that's a really good idea. Now, one of the things that I haven't really had, I've always thought about what are the different factors for lowering cost. And so inventory turnover, stale inventory, that's one of the biggest ones. The other will be like obviously the ROI margin. And what are you looking at as far as a macro with regards to currency exchanges, geopolitical risk, anything along those lines? Do you guys factor in?
We don't factor this at all. Like we don't. Then another thing, I think we look at the two parameters really. One is basically inventory, and by this I mean like turnover days and margin. And so because we want to understand the units economics of a business, then it's about, and by margin, I mean not only gross margin, but also something we call like CM2 or CM3. So contribution margin 2 and 3, which are the margins after logistics and after marketing. Because it's not only about how much you spend to buy the inventory, but also how much you spend to sell it after marketing costs. And then it's about the OPEX, like how efficient your business is as a whole. Like sometimes you have businesses which have a beautiful unit economics, but you're like, guys, you make $500,000 sales, 150 gross profit a month, but you're burning 300,000 a month to run the operation. Like what's wrong with you? And then we also have a client who's doing $1 million sales a month, and it's like 2 people business because they're so efficient. So, this is what differentiates the great companies from average and poor ones.
Yeah, I agree as well. The thing that I'm worried about, because I've got such a big outlay of capital coming up for this Q4, is the currency exchange. This is one of the first years that I'm kind of worried about it, because the currency exchange is so good right now, right? Like right now, a dollar gets you 7.20, 7.2 or 7, roughly 7.2 Chinese yuan or RMB. It's amazing, right? Like, so I can, my money's going further in China. So that's essentially a discount on goods right now. But I'm about to wire $3 million. If between now and the time I wire, that drops to 7 from 7.2 or 3, that's a 3% increase in cost in my cost of goods.
Have you thought about locking in the currency with some provider? There are companies.
So I was looking at potentially buying some options as like a hedge, maybe. I had a Series 3 again a lifetime ago, and I was thinking to myself, well, what is the downside here if this goes to 6.5, right? Like if there's a crash and it goes back to where it was 2 years ago, that would be the bottom. So at 6.5, it would hurt a lot, right? So that's where I'm kind of worried. So if I do 6.5 divided by 7.23, that's a 10% increase in cost of my goods. 10%, that's significant.
So but you are paying now. Are you not locking in the currency exchange now? But because
I'm not, because I'm only when I wire it. Like it's when it's whatever it is the day I wire it.
So you can wire now. Oh, you're worried. You have to wire now, basically. Maybe like wiring now means you should maybe taking credit now.
But then you have the cost. Like what is it costing me to wire it now versus next month? Because I have cost of capital, right? Oh. So like if it's 0.6 or 0.7 to lock it in now, is that worse? So a 10% increase on cost of my goods would be $300,000 on $3 million. That'd be pretty significant, right? Like, absolutely. So I've got to solve this, and it doesn't seem like something you worry about, but it's in the back of my mind from a finance perspective. I had other questions.
From our perspective, like we see such a huge variance in the margins overall. Like this 2-3% movement. Frankly, like the cost of marketing can change from month to month by way more than 2-3%. So
yeah.
And another thing is, me as a founder of this business, when I understand the founders, and I'm taking much longer view on the company than like next 2 months. I'm like, I understand you might have a dip. I understand you might have a problem next month. I will work with you. I never allowed the good entrepreneur fail. Like we'll just like allow you to slow down repayments, give you more money, help you through the crisis. Because I'm in the business of bad news. Every day, some founder has a problem, and I'm like, hey, how can I help you? How can I brainstorm with you to help you out? We've done that.
Yeah. So what is your typical, it's like an LTV question. Like how many loans does a typical client take from you?
Plenty. This is like, best clients stay with us for a very, very, very long time. I have an Amazon client who launched the business a year ago. They started with a small loan with us, I think 50, 100,000. Now they are at close to $1 million, million outstanding balance because they scale so fast. The customers, when they churn, it's usually us churning them because they have issues, they underperform. It's very rare for the clients to outgrow us. And if they do, we help them find they usually, can get a bank financing at some point, which is just much better, much bigger, or maybe some other provider. But
so essentially they outgrow you at some point,
yeah.
But like you help them in that bridge space that we talked about earlier.
It's a very sticky product. Like I think, we actually are not profitable on acquisition with many clients. My business is in a long-term relationship. So it's a predicament, our predicament. It's a must for us to deliver good value to the customer and for them to be happy.
Going back to the previous conversation with Peter, he's just expressed here that they work closely with the larger brands that they work with when they borrow higher. Do you think that a lot of the other lending companies do the same as well, but on the front end, because they have to put fixed numbers on their site or early packages, they put together the financial packages, you don't see the flexibility there? So from the previous situation,
I think it would be better marketing for them if they gave a range and then they just say based on where you qualify. Like that would probably be better because to know that range is there and to be more transparent on the rate, I think it would be better for the seller to know where they fall and why, and then it could be even a learning tool for them to get better.
Yeah. So you're saying it should be more transparent with the rates? Yeah.
I think the transparency on the rates on the marketing, because Danny asked the question about, do you think that the higher rate or what they put on the website is only there because they have to be reflective of what a typical buyer would get?
Yeah.
Listen, I think it's a great question. I actually hired a new head of marketing. She joined us from Amazon, funnily enough. She joined us 2 weeks ago. And we are doing this. Actually, we just sent the mailer. So one of our acquisition channels is direct mail. We literally sent a lot of physical mails to the Amazon merchants. And we are talking about the rates there. I think historically we haven't done on the website. And we do want to do that because if you think about our competition, they are talking about this a lot. Sometimes rates as low as X. I have no idea why we're not doing that today, and I think we might.
But the danger of that is that everyone who comes in who is expecting the lower rate, because no one goes, "Oh, I'll pay the middle or the top." They're coming in for the lowest rate possible, but they may not qualify for it. So that could actually get blowback if the wording's not correct. Because they'll say publicly, you said
it can be seen as disingenuous or like a bait and switch.
And that's the danger. Is like, where do you find that fine line? Like what you said, Peter, you didn't want to lose that client. You knew as they were growing and coming back, you were more and more and more flexible. You're reducing the rate. You're making adjustments and everything else to make it more comfortable for that client. Now you can't put that word in on the website because everyone wants the same flexibility as your 100 million guy. And if it's not presented in the right way, it could be looked at as well. Well, you've got false marketing because when I spoke to you, but the fact is they're not doing 100 million, they're doing 500,000. It's a big difference, and it's very going to come to a very difficult ground because even though you're doing it in the best instance of transparency, it could also blow back because when people talk about stuff, they don't always give you the full picture. They give you their version. Does that make sense? And so if that come across, it might blow back in marketing terms. So it's a difficult one. It's a challenge to overcome to present it in the right way.
Lending is in general very difficult product to sell because you have a lot of customers you have different types of customers. On one hand, you have customers who are like the best customers don't need your product. And they have plenty of options. And then you have customers who are poor customers who are desperate to get the loan, and you reject them, and they're angry, and they're writing an angry review on the Trustpilot. It's a very it's a very interesting dynamic where the more someone wants you, the less you want to work with them, and vice versa. I'll tell you one thing though. Listen, the competition is pretty open. Like, people who work with us, they know usually what can they get somewhere else? It's not like they are talking only to us, like they will be talking to us, Sellerify, someone else. The rate is where it is. I think, you have to be competitive to win the deal. Otherwise, someone will take money from someone else anyway.
Yeah. And a lot of price matching takes place as well. Well, look, if you can show me and prove it open book that they've offered that rate and it's official, then I can match the rate and stuff. But again, very hard to put that into marketing language without any blowback.
That's true. And that's why in reality, you don't win the deals with price. I think price, frankly, is the secondary factor. I think, I can always do the price match with Sellerify. How do you choose who you want to work with next? And what I think you want to work with someone who is reputable, who you trust, where, so what I offer to the biggest clients is, hey, this is my personal phone number. Literally, like, if there's any issue, call me anytime. And my team will go extra mile and work with you to sort the issues. Like, if it has to be, I will fly to you and we'll work out. Like, we have a client who had huge issues. They had, some issues with HMRC. And I had another client who suddenly the business went bad and they had a £4 million borrowed from us. And they're like, guys, we need 5 million more or we're going to die. And we're like, what the fuck? And over Christmas Eve, I was on my holiday in Bali, my first holiday with my girlfriend. And I worked through the night, through Christmas Eve, New Year's Eve, and we approved them for 5 million more over that period of time to save their business, right? And I think this is the extra mile we go to deliver the value to the customers, because we are selling the biggest commodity ever. It's just digits on the bank account. So it's all about customer service to us.
Yeah. And that's kind of the question that I want to get into as well, is on the customer service side, because it sounds like education and assisting with tightening up their business is a big part of it, because the better they are at the business, then the more likely you are to get your money back, right? And then them to grow and then to borrow more money. So do you ever factor in if someone, and I know the answer is probably no, but do you ever factor in that someone's part of the inner circle or part of my group because their success rate is likely more high or higher? Or do you have any way of assessing their knowledge?
We speak for the largest loans. We have a very thorough conversation with our finance team, with a CEO, and understand how they think about their business, what their strategy is, why are they looking for money. And frankly, if we like someone, we will go extra mile and give them longer duration, bigger amounts, because we know they're smart, they're figuring it out. So even though it's hard to quantify, this actually is a big factor of a decision. And that's why we try to, have a very detailed, thorough conversation. And sometimes some clients are frustrated. Why are you asking me this? And the best clients are like, gosh, I love it. I finally have a business partner who's asking me what's going on with inventory, what's happening there. And these clients are the best clients, where we have a really good relationship. Yeah. They share with us the plan. We're like, maybe you have to go harder. Maybe we should push even more. Or maybe slow down. What about this? Your OPEX is too high. Are you really not worried about the acquisition costs?
I love it. Yeah, absolutely. The fact that you understand business and you understand the operations, and then you can ask those questions and get more granular. You're serving almost as an advisor of sorts to them, which is a win-win, right? Their success is your success. And so that's always the mission that is most aligned with the customer. I find that the most successful businesses are usually the ones where their mission statement is the success of their customers.
Yeah,
because
absolutely.
Those are the companies that get it. Those are the founders that get it. They understand that if their customers are successful, they'll be successful.
Absolutely. And for us, the biggest challenge in scaling my business was, how do I train the team to be these advisors to the customers? So one of the things we do, for example, all our salespeople attend the credit calls and credit meetings every day, so they understand what are we talking. And if we give feedback to the clients, we don't tell them you're rejected. We tell them, hey, we can't lend to you because XYZ, because, hey, your inventory turnover is too poor. You have too high costs. You have too much debt. This is not a yes or no. We want to give a detailed feedback to the customer so they understand how can they improve and what can they do to get approved from us further down the line.
Yeah. Well, I appreciate the candidness and the conversation and getting to know you, and Danny for connecting this. I appreciate it. I think that this is a super important conversation for our sellers to hear and to understand. Borrowing money isn't just like picking up the phone or filling out an application and getting money transferred. Like there's a lot that goes into making the right decision and to understanding how to use that capital effectively so that it doesn't at the end of the day cost you money.
Yeah, and don't forget margin suppression as it is. So leading down this road, like you said,
Definitely.
and being open about the situation with the current state of the market in terms of margin suppression for a lot of Amazon sellers and how they're being effective.
You know I've said this before, and I'll say it again. There were several months last year where net I lost money. Right? Now I closed the year out making 7 figures in profit. But we did $22 million in revenue. So that's not hard to do at $22 million in top line to make over $1 million. But if my net was only 6% on 22 million, I wasn't happy with that. Yeah. But at the end of the day, I know why it happened. Those several months throughout the year where my competitors were blowing out inventory and we were still selling inventory that cost us $22,000 to bring in per container versus $2,000, I knew that was going to get better.
Yeah.
And I knew that if I kept my foot on the gas, that I would maintain market share and that it would get better.
Yeah.
Whereas a lot of people will take their foot off the gas to try to get short-term gains, and then they end up killing the product.
Yeah. And you know what? I would also say that most people wouldn't have been that transparent. You run courses and everything that you do, right? So people are holding you up as a beacon. The fact that you were in the red for a period of time last year speaks volumes of the current market and how you need to be sophisticated and look after the cash. And part of that, if you are taking loans, this is what this podcast is about.
And the only reason that I was able to really understand and be okay with it is because I understand I'm so confident in the business and my knowledge in the business. And I know what it takes to grow and what I had in the pipeline with regards to products and the lifelong value of those products and where I was going with growth. The other part of it is new products cost more than existing products, right? Your newer products require a lot more marketing and launch, so your margin is a lot tighter. So as a whole, I launched a ton of products going into summer last year. I had a lot of stale inventory that was at the higher effective landed cost, right? Because of the inventory issues. I had ordered too much in Q4 of some things, right? So I was getting through a lot of those issues, but I knew that if we stayed the course, because of the fact that we're working backwards from goals, and I knew what the contributions were, what the contribution margin of every SKU was, that I would be okay. But a lot of people don't have that type of visibility or granular look at their business, and that they need to be at that level.
Yeah. So hopefully, guys, you enjoyed the podcast. Again, Brandon, how can people reach you?
Best way is probably sellersystems.com. I'm on LinkedIn. I'm on Instagram. And you can always find me on Facebook groups. It's the easiest way. Thank you.
Excellent. And Peter?
Our website is weareuncapped.com. My email is Piotr, Piotr, at weareuncapped.com. You can find me on Twitter, LinkedIn, everywhere else as well. Feel free to reach out.
Excellent. Guys, thank you for joining us today, gentlemen. Again, thank you for being so candid. Sharon will be up next. I'll be here next week. Take care of yourself and your family. Much love, and I'll see you again soon.